Hello and welcome to this third recorded lecture. We're going to skip now from Chapter 3 to Chapter 18 and cover short-term finance and planning. This is going to be sort of a continuation of the accounting ideas, closely related to the accounting ideas. So we will cover here understanding the components of the cash cycle and why the cash cycle is important. The pros and cons of various short-term financing policies. Talk about, we'll go through a simple cash budget. It'll be a little difficult to follow on slides, but you'll probably want to go back through it and work out the calculations. And understanding the various options for short-term financing. Chapter is outlined as shown. So let's start with a little model that shows the balance sheet of the firm broken down into some categories. On the left-hand side we see current assets, and down below that fixed assets, and there are two types of fixed assets, tangible and intangible. Intangible being things like goodwill, and tangible assets being things like property, plant, and equipment. And on the right side we see the liability and equity section of the balance sheet. And liabilities have been broken down into current liabilities and long-term debt. And then what remains is the capital contributed by shareholders or shareholders' equity. The difference between current assets and current liabilities is net working capital. And if you take a close look at that diagram, you'll see that if we take the net working capital plus the fixed assets, we'll get an identity that is equal to the long-term debt plus the shareholders' equity. The net working capital essentially represents how much short-term cash we're going to need. We're going to kind of spin this a little bit into sources and uses of funds. So let's talk about current assets. Current assets are cash and items that are closely related to cash, things that are expected to be converted to cash within a year or the operating cycle, whichever is sooner. So we have cash, we have marketable securities, we have accounts receivable, and the least liquid of those four is inventory. And then on the current liabilities section we have accounts payable, we have accrued wages, and we have taxes payable. All right, so here's the little definition I was pointing out on the chart earlier. If we take net working capital plus fixed assets on the left side, on the asset side of the balance sheet, we get long-term debt plus equity. And if we rearrange that equation a little bit, well, I guess first we're going to define net working capital again as equal to cash plus other current assets minus current liabilities. Now we're going to take that net working capital definition from the second line and place it in the first line and do a little rearranging and put cash on the left side and everything else on the right side. And you see that cash is equal to long-term debt plus equity minus net working capital excluding cash and minus fixed assets. Now this equation we can think of in terms of sources and uses. So first of all, long-term debt. If long-term debt were to increase, that would be a source of money. If equity were to increase, that would be a source of money. If we were to increase net working capital, that would be a use of money, or if net working capital were to decrease, that would be a source of money. And if fixed assets were to increase, that would be a use of money. So the sources and uses of cash flow come from this kind of reasoning. Now let's spend a little time looking at this diagram because it'll be helpful for you to get this in your mind. It's very useful. So up on top, first of all, of course, we have time. Typically, a diagram like this, the baseline represents time moving from left to right. And on the far left, on the top, you see that we have placed an order for some raw materials, and after a short period of time the stock arrives, the raw materials arrive, and that period between the time the order is placed and the time the order arrives is called is just referred to as the raw material purchasing period. Then from the time the stock arrives until we actually finish the goods, so remember that materials go from raw materials and then into work in process and finally into finished goods. Of course, that's the typical manufacturing cycle. If you're a firm like Walmart, a retailer, it's just raw materials directly to inventory. But from the time that the stock arrives until the finished goods are sold is the inventory period. That's the period of time during which we have to fund our inventory. And then from the time finished goods are sold until cash is actually received, if we're selling on account, we get accounts receivable. That's the account receivable period. The inventory period plus the accounts receivable period together, those are both in days, is equal to the operating cycle, which you see down below. Now, you also see down below the timeline there, the time between when the stock arrives and when we actually pay for the accounts for the raw materials is called an accounts payable period. And the time from the end of the accounts payable period until cash is received is called the cash cycle. So just looking at that, you can see that if we take the inventory period, we add the accounts receivable period, and we subtract the accounts payable period, we get the cash cycle. And that's the time from when cash goes out the door until the time when cash comes back in. All right, so the cash cycle is equal to the operating cycle minus the accounts payable period. And remember, the operating cycle is equal to the inventory cycle plus the accounts receivable cycle. In practice, the inventory period, the accounts receivable period, and the accounts payable period are measured in days. Days in inventory, days in receivables, and days in payables. And those are standard ratios. Days receivables, for instance, we say DSR, DRS, days receivables outstanding, DRO. Okay, let's look at an example. Let's suppose that over a period of time, the beginning inventory is 200,000 units or dollars. The ending inventory is 300,000. The accounts receivable has a beginning balance of 160,000 and an ending balance of 200,000. And the accounts payable has a beginning balance of 75,000, ending balance of $100,000. We have net sales during the period of 1,150,000, and we have cost of goods sold for those sales of 820,000. Now, using those numbers, we can count the receivables turnover, days receivables outstanding, the days of inventory outstanding, and the payable turnover period. So let's do that. First, the inventory period. We take the average inventory, 200,000 at the beginning plus 300,000 at the end divided by 2. So on average we had $250,000 of inventory. We divide the average inventory into the cost of goods sold to give us an inventory turnover number. The inventory turns over 3.28 times during the year. And using a 365-day period, that works out to an average of 112 days of inventory outstanding. So the days of inventory outstanding, 112 days. That's the inventory period. The receivables period, or days receivables outstanding, is a similar calculation. We start with the beginning receivables balance, add the ending receivables balance, divide by 2 to get an average of 180,000. Divide that this time into sales. Remember, cost of goods sold is used for inventory turnover. Sales are used for receivables turnover. The receivables turnover 6.3 times per year, and again, using a 365-day year. That's an average of 57 days. Now if we add the inventory period and the receivables period, we're going to get the operating cycle. Operating cycle of 169 days. That's the time from when we get raw materials until we actually collect money for them. Continuing the example, next we calculate the payables period. So again, we take the average payables. We divide the payables into the cost of goods sold to get a payables turnover of 9.37 times, and using 365 days, that works out to 39 days. Now, if we take the operating cycle and subtract the payables cycle, we get the cash cycle. So the cash cycle is 130 days, and that's the period of time that we're actually going to have to finance our inventory. Part of the operating cycle inventory is financed through the payables, but the balance we're going to have to finance for ourselves. If we want to reduce our financing needs, we're going to have to cut down on that cash cycle. We can do that by reducing the receivables and inventory periods, or perhaps increasing the payables period. All right, let's think about some other aspects of short-term financial policy. Two aspects we want to focus on. The first is the size of the firm's investments, and the second is the type of financing policy that we want to use. So how much current assets should we have, and how should we finance them? We have two options for the size of the investment in current assets, flexible and restrictive, and two approaches for financing policies, again, flexible and restrictive. Let's define those. So how big, in general, how should we think conceptually about the size of our investment in current assets? Well, a flexible short-term financing policy would maintain a high ratio of current assets to sales. So defining the term flexible in terms of our current assets, lots of current assets relative to sales. Keeping large cash balances, keeping large investments in marketable securities, having a lot of inventory around, using liberal credit terms would be flexible short-term financial policy. Restrictive short-term financial policy would be exactly the opposite. Low cash balances, little investment or no investment in marketable securities, small investment in inventory, and no credit sales. That would be very restrictive. So here's a conceptual graph. This shows kind of the ideas. We have two types of costs, carrying costs and shortage costs. On the left-hand side, on the y-axis, you can see the costs, and on the x-axis on the bottom, on the horizontal axis, you can see the size of the investment. We have shortage costs, and the bigger the investment in current assets, the less likely we are to experience a shortage. The less likely we are, for example, to experience a shortage in inventory. So our shortage costs are low and declining slowly. On the other hand, as we increase our investment in current assets, our carrying costs rise. We have more money tied up in inventory, in accounts receivable, things like that. So putting those two costs together, adding them together, we get this sort of U-shaped curve. And as you can see, there's sort of possibly a minimum, a point where that total cost is the lowest, and that minimum point would be the ideal level of current assets for us. Now, are we going to have a flexible policy where we have a large amount of current assets, or are we going to have a restrictive policy where we have a short amount of current assets? That really depends on the nature of those two curves working together. So let's see what happens if we have a flexible policy. In other words, let's look at what happens when it's optimal for us to have a lot of current assets. We have shortage costs, and again, they're declining as we increase our investment, but they're declining slowly. And we have carrying costs, and they're increasing, but they're increasing sort of slowly. And when you put these two together, you get the idea we had. You get the total cost curve, and it has a minimum, and that minimum point is the point where we want to hold our current assets. That's the optimal level of current assets. Now, what would things look like if we had a restrictive policy? When would it make sense for us to, optimally, to have a restrictive policy? Well, it's going to turn out that it'll make sense if the curves are much steeper. So in this case, our shortage costs drop much faster, and our carrying costs rise much more quickly. We get this same U-shaped curve, but it's shifted to the left. So we get an optimal level of assets, but it's much lower. So really, it sort of depends on how our carrying cost and shortage cost curves behave. And the more sharply they rise with investments, the more the current assets are going to be shifted to the left, and the more it's going to be appropriate for us to have a restrictive policy. Now let's talk about alternative financing policies. A flexible short-term financial policy would mean a low proportion of short-term debt relative to long-term financing. And a restrictive short-term financial policy would mean just the opposite, a high proportion of short-term debt relative to long-term financing. Now, in an ideal world, and this is very ideal, short-term assets would always be matched up perfectly with short-term liabilities. Long-term assets would always be financed with long-term debt, and in that world, net working capital would be zero. And that's not very likely to happen. Most firms do have positive net working capital. All right, let's talk about the cash budget. Cash budget is fundamentally one of the most important activities that you can engage in as a financial analyst. This is what's going to help your company map out its future needs and help it plan for the future. If you're in the Treasury Department of most corporations, you'll live and die with this thing. Cash budget is the primary tool for short-term planning. Idea is simple. Unlike the income statement, it's similar to the income statement. In the income statement, we match revenue and expenses. What we're going to do here is match cash receipts and cash disbursements. So we're not going to do any of the accruals that accountants do. Cash receipts are going to come from sales, but we're going to need to figure out when those sales are actually collected. Remember that sometimes sales are made on account and the receivables are collected at some time later. So we need to figure out what the actual collection pattern is. And then as far as the cash outflows, we're going to have to pay our accounts receivable, and there again will be a lag between when we actually receive our receivables and when we pay for them. We're going to have to pay our wages, our taxes, and our other expenses. We're going to pay for capital expenditures, which are necessary big ticket purchases to help us maintain our productive capacity. And we're going to have a long-term financial plan. So here's our little example. Now, I'm going to go through about 3 slides based on this information. And it's going to be hard for you to keep all this information in your mind. So what you'll want to do is go back over these slides, go through these numbers on your own, and make sure that you understand how each of them works. So I'll talk about them, but you'll have to do it again. Everything on one of these cash budgets, almost everything, keys off the sales estimate. And we have sales estimates for 5 quarters. The first 4 quarters of this year and then the first quarter of next year. Then we have accounts receivable, and we're going to start out with a receivables balance of $250. And the average collection period is going to be 30 days. Now we're going to think in terms of a 90-day quarter. So 30 days is about 1/3 of a quarter. So what we're going to do is we're going to collect about 2/3 of this quarter's sales, and 1/3 are going to be carried over into the next quarter. Accounts payable, we're going to purchase 50% of next quarter's sales. So for example, when I look at quarter 1 and I say, well, what were the purchases? They're about half of quarter 2. Quarter 2 had 600 of sales, so the purchases in quarter 1 are going to be about 300. And our beginning payables are $125. And our payable period is about 45 days, which is half of a quarter. So about half of our payables are going to be paid this quarter, half our purchases, and half of the purchases are going to be on account payable next quarter. And then we have other expenses. The wages, taxes, and other expenses are 30% of sales. And that 30% is going to be pretty much paid in the quarter that it is incurred in the quarter of sales. We're going to have interest and dividend payments, which are going to be $50 per quarter, constant. We're going to have a major capital expenditure of $200 in the second quarter. That's going to come from our capital budgeting process, which we'll discuss later in chapters 8 and 9. And we're going to start out with an initial cash balance of $80, and the company has a policy, a desire, if you will, to maintain at least a balance, a minimum balance of $50. And there's not a lot of incentive to maintain more than 50, and there's no real interest in, we can't have less than 50 because we need 50 to operate. So we're kind of caught between what we have to have and we don't want to go above it. So we're going to keep $50. So let's start out with the collections. Remember, the average collection period is 30 days, and that implies that 2/3 of our sales are going to be collected this quarter, and the remaining 1/3 are going to be collected next quarter. We started out with receivables of $250. Our sales were $500. We're going to collect 2/3 of that now. Plus we're going to pay for 2/3. We're going to collect 2/3 of that now. Plus we're going to receive the $250 from last quarter. So we're going to collect $583 total. And 1/3 of that 500, or 166.66, 167, is going to be our ending receivables, and that's going to be collected in quarter 2. So we carry that over to quarter 2. I'll just go through one more quarter. Second quarter we have sales of $600. 2/3 of that we're going to collect, which will be $400. 400 plus the 167 from last quarter will give us 567. And 1/3 of that 600, or 200, will be carried over into accounts receivable into the third quarter. So if you're doing this on a spreadsheet, you make one quarter and you just drag this column across and you'll have that done. Now let's look at the payables. First we have payments on account. And remember that the beginning accounts payable was $125. And then we purchased half, this quarter, in quarter 1, we purchased half of next quarter's sales. Next quarter's sales were $600. Half of $600 is $300. And remember that we're going to pay about half of that this quarter, so half of $300 is $150. 150 and 125 gives us that $275. And that same pattern will go on across. The wages, remember, are going to be 30% of our sales. So we had $500 worth of sales this quarter, so 30% of 500 is 150. 30% of 600 next quarter is 180. There's the 200 of capital expenditures that we were given that came out of our capital budgeting process. And there's the $50 of interest and dividend payments every quarter. And if we add those up, you see that our total payments, total cash disbursements, the first quarter are $475, $275 plus $150 plus 0 plus 50, and so on. Now we kind of wrap the thing up in a third slide. So we start out on the first line with total cash collections from the first slide, and the total cash disbursements from the second slide. And the difference will be our net cash inflow. So we're going to have a positive $108 the first quarter. Second quarter we're going to actually have $176 going out. So on. Now we started out with 80 in quarter 1. And we collect 108, or net cash inflows are 108, giving us an ending cash balance of 188. We want to have 50, so we can actually, we have a surplus, excess cash of $138. And we would probably move that into short-term marketable securities. It would show up on the balance sheet at the end of the first quarter. Second quarter, we would have a beginning cash balance of 188 if we left that 138 in cash. We're going to have net cash inflows of a negative 176, leaving us with only $12. We need 50, so we're actually short 39. We have a deficit of 39. We're going to have to put $39 back into our accounts, into our cash. All right, let's talk about short-term borrowing. How do we finance these deficits if we have them? Most common way to finance a deficit is with short-term loan. Usually, most companies have an unsecured line of credit at a bank, and the purpose of that unsecured line of credit is very much like your credit card, except that it's just used to fund short-term deficits, and it's expected, the bank expects that that balance will be zero at least once during every year. Otherwise, it really isn't long-term debt at all. If it stays on the books and you just keep rolling it over, it really should be long-term debt. But a line of credit, or perhaps a secured loan, and there are a couple of ways to secure. We can secure the loan with receivables, or we can secure the loan with inventory. Now, we're not going to get into the costs of these things, but factoring and assigning receivables or using inventory as collateral are very expensive ways to borrow money. First of all, if you look at the accounts receivable, the lender will go through your accounts and basically eliminate those that they think might be somewhat suspect. And then they'll only loan you a percentage, maybe 80, 70, 60% of the remaining accounts, and it'll be loaned at a very high interest rate. Companies, if they're AAA credit rating, might also use commercial paper. Usually commercial paper is limited to the very big companies, the IBMs, the General Electrics of the world. Or a company might use trade credit, which is essentially borrowing from your creditors by getting payables and then paying them at a later time. So those are the typical short-term ways of financing a shortage. That pretty much wraps up Chapter 18. Let's go through a quick quiz and then we'll be through with this. And remember, you need to go back over these slides at least another time. Go carefully through the cash budget. Make sure you understand each item on the cash budget. So you should know at this point how to calculate the operating cycle and the cash cycle, the receivables turnover period, the inventory days inventory, and the payables period. What are the differences between a flexible short-term financing policy and a restrictive one? And what are the pros and cons of each? You should know what the key components of a cash budget are and what the major forms of short-term borrowing are. So I encourage you to read through your text, work some of the homework problems, and go over the slides several times. And that's the end of Chapter 18.